Hello and welcome. My name is Vijay Acharya. My student number is 1481737 and we're going to talk today about the conceptual framework and financial reporting environment in Australia. The table of contents shows that we have got 6 or 7 parts to talk about today. The first one being the financial reporting environment in Australia. Second one is what accounting is and the accounting process. Third one, conceptual framework and the objective of financial reporting. Fourth one, elements of each of the 4 financial report statements. Fifth one, accounting quotient, double entry principle, accounting cycles. And the sixth one is the transactions of Wong Limited. So the first one is the financial reporting in Australia, and which shows about how the accounting standards and regulations are implemented in Australia. So financial reports basically involves all the financial information that the stakeholders and the users of the financial report need. So financial reporting is basically done by AASB, which is Australian Accounting Standard Board, and ASIC being the main part, which is Australian Securities and Investment Commissions. So these two bodies normally look after the financial reporting in Australia. And the company should comply with the accounting standards and regulations for better financial reports every time. Another part is the accounting and accounting process. So the accounting is basically the process of recording, summarizing the transactions, so we can record all the transactions in one place. So when at the end of the year we can have a look with everything, and all the informations will be in one place. There are 9 parts to accounting process, and the first being analyzing the transactions. Second, we'll just post all the transactions into a journal. All the transactions of journal will go onto the ledger and ledger to trial balance and everything. So we'll just discuss that part in a couple of minutes. So the accounting process is very important for all the companies because the accounting has to be done for all the companies, and it can be done monthly, quarterly, half yearly, or annually, and it basically differs with all the companies. So the conceptual framework is very important for all the companies in Australia and all over the world because it is governed, and this one is the conceptual framework is basically a set of rules and guidelines for the transactions and the reporting process. So all the rules and regulations should be intact to produce a better result and better financial reports. So to make the better financial reports, conceptual framework gives a rules and regulations so that we can have a look and we can implement that to make a better financial reports for all the users of financial statements. So users of financial statements can include the stakeholders, the shareholders, creditors, employees, staffs, government bodies. So when they look at the financial reports of the company, they should be able to identify that the rules and regulations has been implemented properly, and the financial reports are true and gives a true and fair value for all the stakeholders. So the conceptual and the main purpose of conceptual framework is to assist the accounting standard board. So when the conceptual frameworks gives a set of rules, the accounting AASB or Australian Accounting Standard Boards can implement those into the financial reports, and it gives a true and fair view for all the users. So we'll just go on to the objective financial statements. The main objective of the financial statement is to provide the financial information for all the stakeholders or all the users of financial report decisions, as we discussed earlier. So we'll just talk about the main part of the financial statements today. So main parts of the financial statements are income statement, balance sheet, statement of cash flows, the statement of change in equity, and notes to financial statement. So the income statement normally have a part of income and expenditure, and it comes from the trial balance. So all the when all the processes are gathered up, then we'll prepare the income statement. The part of the income statement will go on to the balance sheet, and balance sheet will have the assets, liabilities, and equities onto the right hand corner, and the assets onto the left hand corner. So next one is the statement of cash flows. It will normally include how much money you have in the company, how much is your cash outflow, how much expenses you have, how much is your cash inflow. So that determines the cash flows of the company. The fourth one is the statement of change in equity. The statement of change in equity is normally comes with the profit and loss account, and it gives a retrospective effect of the income and expenditure statement. So if there is any changes, then it will be included in there. So notes to financial statements will be the last part, which is after making the financial statements, if there is any things that has been missing and that has to be included, then it will just go on to the notes to financial statements. So the elements in financial statements, these are very important. First being the assets. Assets are like the company will normally have all the things to run the business. So assets can be like land, building, furniture, equipment. Those are the assets of the company. Liabilities can be short-term and long-term. Like if you take a bank loan, then that can be a liability. Owner's equity are the shareholders. Dividends has to be paid for all the shareholders, and owner's equity will include the shares of the share capital of the company. So revenues are the incomes, and expenses are the expenses, the daily expenses, operating expenses that the company normally has. Alright, so the next part we'll be discussing today will be the journal entries. The journal entries, we have got a journal entries of the Wong Limited, which gives an idea of the transactions. So onto the left hand corner here, we can see that this is a transaction, and this is the effect, and this one we have got here is the journal entries of the Wong Limited. So if we discuss this one, then we'll be clear how the parts will go through. So the first process on to making a financial statement is the journal entries. Then we'll just post this one to the ledger account. Ledger account will go on to trial balance. Trial balance will go on to income statement, and income statement will go on to the balance sheet. And that's how we make the financial statements. So first thing we have to know about this is what happens if the account goes up or down, right? So we have to finalize, or we have to think which account is this, whether it is asset, equity, liability, expenses, or revenues. So this process has a double entry transaction. So double entry basically means it has to have a effect in two parts. So if one increases, another one has to increase, or one decreases, then another one has to increase. So it has to go with the two double parts. So in the first transaction, we can see that the issue shares for cash for $10,000. So this one will normally have the effect in the cash and shares. So the first one is cash. So when we issue the cash, when we issue the shares, then we will receive the cash. So when we receive the cash into our company, then the cash will increase. And when we give the shares, then the share capital will also increase, and it will go on to the shareholders. So when the asset will increase, it will go on to the debit side. And when the equity is increased, it will go on to the credit side. So asset will go, if the asset is increased, it will go on to debit side. If asset is decreased, it will go on to credit side. If the equity or liability is increased, it will go on to credit side, and if it is decreased, then it will go on to debit side. So the account name for this is cash, and the second account name will be capital. So when the cash is increased, then it will go as a debit, and when the share capital is increased, then it will go as a credit. So the first thing we have to know is to find the elements like asset, equity, liabilities, revenue, or expenses, and then we can just go with increase or decrease, and then we'll just post it into the journal, so that'll make it a little bit easier. So the second part is, we'll just go with few parts to make it easier. So the second part will be borrows money from a bank for 5,000. So when the company borrows money, then the company's cash will increase. So the cash is increased, cash is an asset. Second is we got the money from the bank, so the bank loan will increase, which is a liability. So when the asset will increase, then it will go as a debit, as cash. When the bank loan will increase, which is a liability, it will go as a credit. So that's how we post the transactions into a journal entries. Second part, we'll discuss about the ledger. So ledger, when we make the journal entries, then all the journal entries will go on to the ledger account, and ledger account will summarize all the account names into one transaction. Like in the previous chart, we had a share capital, and it was share capital, cash to share capital. So when it was cash to share capital, then the cash has to go on to the credit side. This one is normally known as the debit side. This one is normally known as the credit side. This one is a share capital. So when we have to post it into the ledger account, then the share capital, the cash will go on to the credit side as $10,000. If we have any more of these transactions, then we'll just add up onto the same account. The closing balance will be the opening balance of the last year or last month, and the opening balance, the closing balance will come here, and the opening balance will go there. That's how we make all the ledgers count. Now, after going on to the ledger accounts, we'll just post all the transactions into the trial balance, and trial balance will normally come up as a with the account name. So when we post all the transactions into from the journal to the ledger account, and ledger account to the trial balance, then all the trial balance will have the account name, and the account name will come as cash, like advertising, supplies, prepaid expenses, how we made the transactions, just like that. Sorry. How we make the transactions just like that, and all the account name from the ledger will come here, and all the amount will come onto the debit side and the credit side, and the trial balance, the total amount of trial balance has to be equal on debit side and credit side. And sometimes what happens is there will be some transactions which will be missing, which makes a error into the financial statement or trial balance. Then we have to make a adjusting entries to correct the trial balance, and we'll just go with the further process, and we'll make the adjusted trial balance, which will include all the transactions of trial balance and the adjusting entries which was making an error. And then when the adjusting trial balance will be complete, and then it will go on to the income statement, and income statement will be forwarded to the balance sheet. On balance sheet, it will normally include all the transactions or all the processes of the assets, equities, and liabilities. And when all assets, liabilities, and equities will be finalized, then the balance sheet will get complete, and we'll go with the changes in equity and all the transactions. And after that, the financial statements will complete, and the company will go and issue the financial statement. So that's all for today. We have discussed pretty much about the conceptual framework, a little bit about conceptual framework, mostly on about the journals, ledgers, trial balance, and everything. So if there's any question, feel free to ask me. Thank you so much for today. At last, once again, My name is Vijay Acharya and my student number is 1481737. Thank you.